Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello and welcome back to another episode. Today's topic is on what is a reasonable compensation for an S corporation owner. Now, before we get into that, this episode is brought to you by Jetro, a digital accounting firm servicing business owners around the country, helping them relieve stress around financials and save thousands in taxes. I am your host and founder of Jetro, Mike Jesowshek. Again, today's topic is on what is a reasonable compensation for an S corporation owner. And this is part 5 in a series of ours. So if you have not listened to our prior episodes, be sure to do that first to get some background information about how we got to where we are today. The first series in the episode was what is a pass-through entity? Then we talked about what is an LLC and how is it different from an S corporation. Then we talked about what it is an S corporation and why should I elect to be one. And then we talked about what are the requirements for an S corporation and how do I go about setting that up. And today we're going to that next step. We're talking about that reasonable compensation piece. So as we've been talking about S corporations in this series, you know that as a S corporation, you're required to take a reasonable compensation as the owner of the S corporation. And so that's what we really want to drill into today. What is a reasonable compensation for an S corporation owner? And when we think of that question, that's really a $1,000 question. And unfortunately, the IRS does not give us clear guidance in this area, but they are able to at least point us in a direction to get some insights on how they would approach this type of situation. So the IRS states that an S corporation must pay reasonable compensation to a shareholder employee in return for services that the employee provides to the corporation before non-wage distributions may be made to the shareholder employee. And they say that the key to establishing reasonable compensation is determining what the shareholder employee did for the S corporation by looking at the sources of the S corporation's gross receipts. So we look at services of the shareholder, services of non-shareholder employees, or capital and equipment that was able to produce those gross receipts. And so when the IRS looks at determining reasonable compensation, or when they choose a reasonable compensation for an owner, they're looking at training and experience of the owner, the duties and responsibilities, how much time and effort is devoted to the business, what is the history of dividends. They're looking at salaries and payments to non-shareholder employees, and they're also looking at comparable businesses doing similar type of services, as well as agreements and things like that. So this is kind of what the IRS states is a reasonable compensation. And as you can tell, it's not very clear. They kind of leave this up to interpretation. But we've made some decisions on how we determine a reasonable salary for an S corporation owner. And we did this based on experience that we've had working with S corporations, court cases we've studied. And so we've developed some methods that we can use to determine that reasonable salary. And so we always say that there is no magic bullet to determining a salary that the IRS will label as reasonable. But there's 2 options that I want to go through that we can use as starting points with clients. And I want to reiterate that. This is a starting point. This is really a conversation that you should have with an accountant, but it's a very hot topic. And I wanted to be sure that you had some kind of substance as a starting point to determine your salary, and then we can go from there. So when we talk to clients, we really talk about 2 options to determining that reasonable salary. Option number 1 is what we call the easy method, but it's harder to defend against the IRS. And using this method, we use a percentage of net income prior to the owner's salary. And so using this method, we say that the percentage that you use for the salary portion should be a minimum of 30%, but can often range from 30 to 50% or more. So an example would be you have net income prior to taking any salary of $100,000. Using this method, you would be in the $30,000 to $50,000 range for a reasonable salary, with that number being closer to 50% being less risky, so that $50,000. So again, this is what we call option number 1. It's easy because you're just taking a percentage of net income, that's your salary. But the hard thing is that it's hard to defend in the event of an audit because you don't have any background support to it. Option number 2 is what we call the harder method, but easier to defend against the IRS. And so in option number 2, we determine the amount of hours that you spend doing various tasks within your business on a yearly basis. So you might start off by taking how many hours you do in a week, multiplying that out to get an annualized number, and you would calculate those hours that you spend doing your specific job as one item. So if you're a lawyer, how many hours a week do you spend being a lawyer? Then you calculate how many hours you spend doing administrative duties. This would be office work, bookkeeping, filing paperwork, whatever it might be. And then we determine how many hours a week do you spend, or how many hours a year do you spend doing marketing duties. So we calculate how many hours we spend a week, annualize it out to see how many hours we spend in a year doing those 3 items. The specific job that we are, lawyer, marketer, plumber, whatever it might be, how many hours we spend doing administrative work, and how many hours we spend doing marketing. And that's marketing for our business. If we have a marketing agency, it's not marketing for our clients, it's marketing for our specific business. The next thing we do is we find the rate someone doing those various tasks in your city and state gets paid. And so this is actually public information where you can get average salaries or hourly rates for various different job titles. And you can find that by city, state, various places in the US. And just go to bls.gov and you can navigate that website to find those rates across different job types and different locations. Again, it's bls.gov. So once we find that rate of what someone in your city and your state gets paid, we multiply that rate by your yearly amount of hours worked, and that gives us a number. So that number might be $40,000. Next, we add in any adjustments for special training that you might have done, licenses that you have, certifications, etc. And then we also add in any other special considerations. So let's say you have a highly compensated non-owner employee that's doing a very similar job to you. Obviously would not make sense to pay you less than that employee. So we factor in other special considerations like that. Once we take all of that data, we add it together, and then we land at your final reasonable salary. So again, take the amount of hours worked in a year, multiply it by the rate in your city and location, add in any adjustments or other special considerations, and there we land on a final salary that you can pay yourself. So when we look at those 2 options, obviously option number 1 is easier to complete, but the biggest downfall is that you do not have any substantiation to back up your salary in the event of an audit, where option number 2 takes a little more legwork up front. But in the event of an audit, you have backup to support your determination of your salary. And so that's where you want to determine what you want to do. And again, both options 1 or option number 2, are simply starting points to figuring a reasonable salary. Each taxpayer is going to be different, and you'll want to sit down with a tax professional to really drill down to find out what that salary should be for your business, your location, and for the work that you're doing for it. So those are the 2 options that we look at when we're determining that reasonable salary. And by the way, we also do have a calculator for option number 2 where you can use as that starting point. So reach out to us if you'd like a copy of that for yourself. Now, a lot of clients, we get to this point, and obviously, to step back, with an S corporation, our goal is to have as low as possible as salary, because the lower the salary means the less self-employment taxes. But also a low salary means we could get audited by the IRS and have to pay that back. So a lot of clients say, what happens if I take too low of a salary? They want to kind of know what this process looks like if their salary is in fact too low. And so the IRS has the authority to reclassify payments made to shareholders from non-wage distributions. Again, these are the distributions not subject to self-employment tax. The IRS has the authority to reclassify those to wages if they feel your salary was not reasonable enough. So basically, in the event of an audit, you would need to provide support that backs up the salary you took as a business owner. And if the IRS determined that your salary is too low, they would reclassify some distributions you took into wages, and then you would need to pay back taxes, interest, penalties, and fees on that. So let's use an example. Let's say you took a reasonable salary of $50,000, but the IRS comes in and determines that that salary should be $80,000. And let's say in that same example, you had distributions of $60,000. So you had a salary of $50,000, you had distributions of $60,000, and the IRS determined that your salary should have been $80,000. In this situation, the IRS would simply take $30,000 of the distributions and reclassify them into wages. And then you'd have to file back taxes, payroll, interest, etc. on that amount that you should have ran as payroll back whenever this audit period was, but didn't. So that's what happens if you take too low of a salary. And that's why it's important that we're keeping a salary that's reasonable in the IRS's eyes to make sure that we're keeping them happy and being able to avoid that back tax, interest, penalties, and fees. Now, one other thing is that if you took, some clients will say, well, Mike, I just want to leave the funds in the business account. So can't I just leave them in there? I'm not taking any distributions. So what are they going to swap out? And if you take 0 distributions in a specific year, there would be nothing to reclassify. So that's a good example. However, if you then took a distribution the next year, the IRS would require you to pay the salary that you should have taken in the prior year when you took no distributions. So let's say you run a business, you have a profit, but you just leave all the money in the business and you take no salary. Then in year 2, you take distributions out from all that money that you left in the business the prior year. The IRS is going to say that's totally fine, but you need to run a back salary for that year that you missed. So in year 2, you're going to have to run a salary that you should have took for year 1 and what you're taking now for year 2. So you can't just pile up a bunch of 0 distributions and then take 1 year's worth of salary to take them all out. So just keep that in mind. Now, the next piece is, how do you run payroll? If you don't currently have employees, running payroll might be something you're like, how do I do that? And so we typically recommend a payroll software. We recommend a software called Gusto. That's what we use internally for our firm. That's also what we use for our clients if we're managing payroll. The reason that we use Gusto is because they take care of all of the payroll processing needs. They handle filing all the tax payments and making all the tax filings on your behalf. So if you need an introduction to our rep over at Gusto, contact us and I can invite you into the software so that you can access the Gusto software. But when it comes to running payroll, you have a few different options. Option 1, which is likely probably the easiest, is to just set up a regular payroll schedule, whether that's weekly, bi-weekly, monthly, whatever it might be, and just run payroll to yourself on a normal basis. So let's imagine you decide that you want a weekly salary and your salary is $52,000 a year. Run a regular salary to yourself at $1,000 a week to add up to that $52,000 a year. So just running a salary on a normal, regular basis. Option number 2 would be to take distributions out of the business as you need money. And then at the end of the quarter, true that up and run an off-cycle pay run for your reasonable compensation amount. And this is going to move a portion of those distributions that you took into wages, and then you can just pay the tax portion at that time. So option number 2 is where you just take money out of the business as you need it. You transfer it to your personal account. And then at the end of the quarter, you're going to move some of those draws, those distributions that you took, into a salary and then pay the taxes on it on a quarterly basis. Now, option number 3 would be if you elected a late election. So last week we talked about filing a late election. So let's say you're in August of the year and you backdated an election to January 1st. So if you elected a late election, you're going to need to be caught up on payroll for the part of the year that you already missed. So if it's August and you didn't run any salary for January through August, you would have to run a back pay run for that. So in this case, you'd run an off-cycle pay run for the tax portion and then move to either option number 1 or option number 2 moving forward, where you're on that regular cadence or running a regular pay run for yourself. So that's what I wanted to talk about reasonable salary, a reasonable compensation while using an S corporation. Next week, we're going to talk about, so I'm an S corporation, now what do I do? Is there anything else that I have to do? We always talked about salary. We always talked about how we get to an S corporation, how we elect to be taxed as an S corporation. Now, is there anything else that I need to be aware of? So that's what we're going to talk about next week. But before I go, I do want to go through and just kind of do a quick rundown about what we discussed today. So when we talk about reasonable compensation for an S corporation owner, the IRS does not give much guidance. They give us they point us in a direction, but they don't give us any kind of magic bullet to find out what that reasonable compensation is. And so they determine that reasonable salary based on various different factors: your training, how much time you're putting in, what other employees in your business are getting paid, what someone typically gets paid for the work you're doing and the time you're putting in, and things like that. So what we determined is what we've done as a firm is use two options as starting points. And these are starting points to determine your salary. These are not just foolproof ways. These are just things that we've learned through the tax code, what we know gets typically audited by the IRS as starting points to determine what that reasonable salary might be. The first option is the easy method, which is where you just take a percentage of your net income prior to your salary, and that's going to be your salary amount. And that percentage could be anywhere from 30% to 50% or more. And obviously, the higher the percentage, the less risky or less chance of an audit you have. So example would be if you have a net income prior to any salary of $100,000 and you choose 50%, your salary would be $50,000. Option number two is a little bit harder method, but it's easier to defend in the event of an audit. You need to take all the hours that you put in doing various tasks, what you do for your actual work. So if you're a lawyer, how much time you spend being an actual lawyer, how much time you spend doing administrative duties, and how much time you spend doing marketing duties. You then take those hours, multiply it by the rate that someone in your city and state gets paid for doing that same type of job, and then you add in any adjustments for any special training certifications or any other special considerations, and then you come to a reasonable salary there. Again, this could be a starting point. You might add in some more or subtract some less for various situations specific to you. These are things, when we're looking at what is that reasonable salary, you should be discussing with an accountant about this. It's important to look at that to see what makes sense for you specifically, as no taxpayer is going to be the same in this case. Obviously, option number one is easier to complete, but harder to defend because we don't have any concrete evidence on what we use to support our salary. Option number two is harder to complete, a little bit more legwork up front, but we have some concrete evidence to help defend that salary in the event of an audit. And finally, if you take too low of a salary, basically what the IRS is going to do is they're going to move some of the distributions that you took into wages, and then you're just going to need to pay back taxes, interest, and penalties and fees on that wages that should have been taken but were not initially. So that's what would happen if you take too low of a salary and the IRS comes in and audits your company. And then how do you run payroll to yourself? If you're not running payroll already with employees, we recommend a software called Gusto. It's going to make it very easy to file your taxes, make the payments, file the forms, and everything else. And so we recommend a software called Gusto for this. And you can set yourself up on a regular schedule, whether that be weekly, bi-weekly, monthly, just a regular cadence where you're constantly paying yourself a normal payroll, whatever that reasonable amount is. Or you could do option number two, which is where you just take money out of the business as you need it as a distribution. And then every quarter you true that up and move a portion of those distributions into a reasonable salary and then just pay the tax portion on it. So I hope that helped clears things up, makes things a little bit more clear about what is a reasonable salary for you and your business. And again, in our next article, we're going to discuss, so now that I'm an S corporation, now what do I need to know? Is there anything else that I need to know outside of what we've discussed so far? So I want to thank you again for listening to another episode, and I will see you guys next week. Now, one last thing before I go. Don't forget to check out our podcast website at www.jetrotax.com. Simply click resources and then podcast, where you can go there and check out our past episodes. Also, don't forget to join our free bookkeeping training program and free Facebook group. I've provided links to both of these in the show notes below.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.